So which school of thought is correct and what would you recommend?
So what happens is that people need to be mindful of base rates. By base rates, what I mean is that if you go India's liberalization 1991-92, so now we are 32, 33 years down the line. In 33 financial years, India's nominal GDP growth is 12.5%.
Okay.
Say 6.5% growth and 6% inflation, roughly.
Yeah. So basically, if the growth of the Indian economy has been 6%, you need to add inflation on top of it because the relative price has increased.
Yes.
And when you add up those two things, it becomes
12.
What is that called? Real.
Nominal.
That is called nominal.
Nominal.
Okay, fine. Uh-huh.
Nominal minus inflation is real.
Right. Got it.
But so what happens is that if that's the nominal growth, the fact is that for Sensex, Nifty, all these indices which we track, the earnings of their companies is also in that vicinity, 12 to 13% over last 30 years.
Growth of earnings. Earnings means profits. Profit growth has been 12-13% of the biggest companies in Nifty and Sensex.
Absolutely right. And the fact is that the price movement of Sensex and Nifty, meaning the growth in the index itself, so GDP growth, profitability, and the stock price, that itself has also compounded about 12%. Plus, these companies, there is 1.5 to 2% dividend per year. So the actual movement of Sensex and Nifty itself is 14%. So what happens is that, if you invest in good mutual funds, you may have got 16, 17, or, somebody says, forget mutual fund, index itself is 14. Why I said base rate means that if you get 14, 15%, that's the long period average. That's how it works. That's how it is. But if you saw September 2024, and then we are talking this asset allocation discussion, at the peak, you take 3 years, you take 5 years, you take 10 years, people were sitting on 18%, 20%, So when people get returns much more than past averages, when people get returns much more than what was originally expected or guided for, then they should know that, okay, it's not like I am a star. It's just that, right now,
this frenzy.
There is a frenzy. See, if the long period average is 15, how can you earn more than 15?
Basically, how can you earn more than what the country itself has grown?
Yes. So it will only happen that, look, the long period average is 15, but last 5 years I am earning 20. So at some point in time, it has to go well below 15 for the average to match up, right?
Correct. So this is sort of like the Buffett indicator as well, right? It looks at the ratio of the GDP and the market valuation of the company.
So if next 3, 4, 5 years of GDP growth, corporate performance, if everything is being factored into the market cap, that is when you get much more than the base rates.
So let me ask a question.